If you're tracking strategic shifts in emerging markets, you know the sound of change. In Nepal, that change, well, it has a very distinct sound. It's that incessant hum of QR code confirmations you hear everywhere in the markets of Kathmandu. It's basically the soundtrack of retail payments going digital.
And, for anyone really focused on the future, that sound, it's a huge distraction, a massive one. Mistaking that for the end game is a serious strategic mistake.
Okay, let's dig into that right away, because when we started looking at the sources for this deep dive, the mission became really clear. We have to move beyond just, the digital wallet boom, the consumer side of things, and focus on the real prize.
Yes.
The high-stakes, multi-billion-dollar prize, which is small, medium enterprise credit, SME credit.
Precisely. We are talking about the absolute engine of the Nepali economy. Your workshops, the local kirana shops, the small tech startups, all of them. And yet, they face this staggering credit gap. Our research suggests it's over $1 billion US. The commercial banks, they just fundamentally ignored this whole segment.
$1 billion. That's a monumental amount of potential just sitting there, untapped. So why? Why are traditional banks just leaving that money on the table?
It's not a market failure in the way you might think. It's a data failure. A pure and simple data failure. The whole system demands collateral that these SMEs just don't have, a land deed, audited books. And what's so fascinating is that the payment war you mentioned, SEO, Kulti, IME Pay, was never really about the fees. It was a proxy war to get the data, the transactional data needed to solve that billion-dollar problem.
So we're framing this whole deep dive around that idea. The payment system is just the first step. We need to dissect 3 key pillars then. The data strategy itself, how that data becomes a new kind of collateral, and the huge regulatory tension that's going to decide who wins.
Absolutely. That's the whole story.
All right, let's start with what the sources call the wallet Trojan horse. We usually look at these digital wallets, ISOA and the others, and we analyze them based on transaction volume, fees. But the sources are saying that's a complete misreading of why they even wanted a payment service provider license in the first place.
The PSP license is just the ticket to the game. It gets you in the door. The real long-term business model is not about making a few pennies on a utility bill payment. It's about taking millions of those tiny transactions, that hum we talked about, and consolidating them, building a coherent, high-fidelity financial profile of a small business.
So in reality, they're sophisticated data aggregation platforms just masquerading as payment companies.
That is the most accurate way to describe them. Think about a local kajagar, a small canteen. For decades, that business was financially invisible. All cash, impossible to assess for a loan, no paper trail, and definitely no land for collateral.
But now that same owner is generating these verifiable data signals every single day.
Exactly. Think it through. The owner takes QR payments for lunch. They pay their vegetable supplier with a wallet-to-wallet transfer. They pay their internet bill, their electricity, all digitally. Every single one is a data point. The volume of QR payments tells you about daily revenue, even seasonality, paying your bills on time signals, discipline, capacity.
And when you aggregate all of that over a year, you get a much more accurate picture of that business's health than any stamped document a bank asks for.
And we've seen this play out before. The sources draw a direct line to China's Ant Group.
Wait, I have to jump in there. Because the Ant Group parallel, it brings a big note of caution, doesn't it?
Yeah.
I mean, they used Alipay data to power Zima Credit and issued millions of loans, yes. But they also faced a massive regulatory crackdown precisely because that scale, that speed of lending on unregulated data, it created huge systemic risks. Does that mean this path in Nepal is, inherently unstable, destined for a collision with the regulators?
That is the central tension the Nepal Rashtra Bank has to manage right now. The Ant Group comparison isn't just a success story. It's a cautionary tale about scale and regulation. Ant proved that payment data can unlock billions in microlending. That's the opportunity. But the crackdown showed that if the regulator doesn't get ahead of it, the system grows so fast that the risk becomes unmanageable. So the lesson for Nepal is that, yes, the payment plumbing is foundational, but the credit superstructure you build on top, it needs immediate, specific oversight.
So the key takeaway for anyone evaluating these companies isn't just transaction volume today, it's the latent value of their data for underwriting loans tomorrow.
That's it. The war was never about who processes the payment. It was about who owns the customer's financial identity, because that identity is the key to profitable lending at scale.
Which brings us perfectly to our second pillar, this idea of replacing traditional collateral. Banking has always relied on the 3 C's of credit character, capacity, and collateral. And for most SMEs, the conversation stops cold at collateral. No land deed, no loan. Fintechs are swapping that out for what they call alternative data.
And this is where it gets really specific, really actionable. We're moving beyond just payment history, although that is still the most powerful signal. The transaction data, volume, frequency, seasonality, that's your bedrock.
Okay, so what are the other critical streams they're pulling from to figure out creditworthiness?
The sources point to two other big ones that quantify reliability. First is e-commerce and social commerce data. So many small Nepali businesses, especially in crafts or fashion, run on Daraz or even just Instagram and Facebook. Fintechs can plug into their APIs and see sales volume, average sale price, and this is crucial customer review and ratings.
So a 4.8-star rating over 1,000 sales isn't just a nice to have. It's a digital, measurable form of character.
It absolutely is. A high rating, a low return rate that shows quality, stability, customer trust. These are powerful predictors that a traditional loan officer could never, ever access.
And the third one, which you said is maybe the most powerful, supply chain data.
Right. This goes beyond what the business sells to how it operates. Fintechs are partnering up with the big FMCG distributors, the guys who supply everything from Coca-Cola to YY noodles. These distributors have their own apps that thousands of little shops use to order stock.
So by integrating with those apps, the fintech gets a live window into the shop's operational heartbeat.
A direct window. They see the sell-through rate. How often does that shop need to restock? Are they paying cash on delivery, or are they using the 7-day credit the distributor offers and paying it back reliably? A loan based on that data isn't a guess. It's a calculation based on the live velocity of that business.
Which leads to the velocity advantage. So why can't the big commercial banks just do this?
Yeah.
Start using these APIs.
Because their entire cost structure is wrong for it. The manual work for a loan officer at a bank to process, say, a small NPR 500,000 working capital loan, it costs so much that the loan is actually unprofitable for them. Their systems are built for big, slow, collateralized loans.
But the fintech algorithm can just ingest all this data and spit out a decision in minutes.
Yes, at almost zero marginal cost. And that automation lets them offer the exact thing SMEs need: small, frequent, short-term loans. A 30-day loan to stock up for a festival, not a 5-year loan for a new building. That's the game changer.
Okay, so if the tech is the engine, then the Nepal Rashtra Bank, the NRB, is the one holding the keys. This moves us to Section 3, the ultimate kingmaker, regulation, and this whole concept of open banking.
Open banking is the essential plumbing for this all to work at scale. It's a framework that basically forces banks, with customer consent, of course, to share financial data with third parties like fintechs through secure APIs.
So the API is like a secure digital doorway. It lets the fintech peek at the bank's data, but only with permission and only at the data it needs.
That's a perfect way to put it. For a fintech lender, getting 12 months of bank transaction history with one click, that is the absolute holy grail for instant, accurate underwriting.
The NRB sees the upside, but also the risk, so they've gone with this cautious regulatory sandbox approach. But the sources suggest this caution is creating its own problems, kind of paradox.
That's the core of the issue. For the big commercial banks, open banking feels like an existential threat. Their customer data is their most precious asset. The idea of being forced to share it with some nimble startup who could then just cherry-pick their best SME customers, well, they're fighting it hard.
Which gives them a huge incentive to drag their feet, probably citing things like security concerns or privacy.
Exactly. The term the sources use is malicious compliance. They follow the letter of the law, but they kill the spirit of it. They'll slow walk the API development, they'll build clunky interfaces that are hard to use, or they'll just charge crazy fees for access.
And for a venture-backed fintech, that kind of delay can be a death sentence. So what's the big systemic risk if this friction continues, if the sandbox doesn't speed things up?
It creates what we have to call the shadow system risk, a really serious risk. If the fintechs get frustrated enough, they'll just find workarounds outside the NRB's control. They might use less secure methods like screen scraping, where you literally give them your banking username and password, a massive security nightmare.
Or they just bypass the formal banking sector entirely.
Yes, they'll rely only on their own closed-loop wallet data, or partner exclusively with non-banks like telecoms and retailers. So the most dynamic, innovative part of the financial sector gets pushed into the shadows. It becomes a parallel system that's much harder for the NRB to monitor, to regulate. It's fundamentally destabilizing.
If you look at India's approach with UPI and the account aggregator, it was top-down. The regulator mandated it. Is Nepal's cautious approach a mistake then?
That is the critical question. India's government said, this is happening, here are the standards, comply. Nepal's path, while understandably cautious, risks breaking the market into pieces and actually undermining the stability it's trying to protect. The NRB has legitimate concerns, no doubt, but caution that prevents integration might be the most dangerous path of all.
Okay, so that sets up the future perfectly. Let's look at the strategic outlook, maybe to the 2026 horizon. There seem to be two very different paths this could take.
The first path, the positive one, is the scenario of accelerated integration. In this future, the sandbox pilots work well, the market demands action, and the NRB mandates clear API standards with a hard deadline. The banks realize they can't fight it anymore, and they shift their entire strategy.
They move to more of a fintech as a service model.
Precisely. The bank brings the capital, the balance sheet, the regulatory cover. The fintech brings the slick algorithm, the fast onboarding, the data analysis. So the bank starts offering white-labeled digital loans powered by the fintech. It's a win-win. It's the fastest, most stable way to close that billion-dollar credit gap.
But the sources seem to hint that another, more likely scenario is playing out right now: the protracted Cold War.
Yes, this is the fragmented future. The sandbox stays slow. The banks successfully block any meaningful mandatory data sharing. So the fintechs go for the bypass strategy. They build their own proprietary data moats, closed systems, exclusive deals with FMCG companies, with telecoms.
Which creates a balkanized credit market. It sounds incredibly inefficient.
It is. Credit becomes siloed. If your SME uses Fintech A, you get great credit. If you use Fintech B, you're in their system.
Yeah.
But if you're outside those walled gardens, you're still locked out. And the banking system gets relegated to just serving its big corporate clients, while systemic risk actually goes up because you have all these opaque algorithmic systems operating without consolidated oversight.
So if we strip everything else away, the tech, the entrepreneurs, which we know are there, what's the hard truth? What's the real bottleneck?
The bottleneck isn't capital. It's not talent. It is a crisis of institutional will. It's the cultural inertia from the banks that don't want to give up control, mixed with the possibly counterproductive caution from the regulator. The fintechs built the engine. The data science works. But the engine is useless if you won't give it any fuel, and the fuel is data.
So looking back at this deep dive, it's pretty clear. The payments war was just the opening act. It was a data war. And that data is the new collateral for a huge part of the economy. The NRB's sandbox. That's the kingmaker for this whole billion-dollar prize.
It is. And the final thought for you to really chew on is this. You can have the most sophisticated credit model in the world, one that could unlock incredible economic growth. But it's utterly useless without access to the data pipelines and a clear regulatory framework to operate in. The fundamental question for Nepal's future isn't a technical one. It's whether the regulator and the banks will finally grant the license and mandate the framework to let these new credit engines run at the scale the economy desperately needs. The key isn't building a better mousetrap. It's being allowed to set it where the mice actually are.
A compelling and very high-stakes thought. Thank you for dissecting all of this with us. We'll see you on the next deep dive.